Hey, everybody. This is AJ with Trading Trainer. I'm glad to be back. And I'm so excited because of the topic of this month's multi-speaker event, and that is long-term investing. Because I've been focused since 1997 and teaching since 2003 options. And when people think about options, especially traders, they think about using options as leverage. But the scoop is that options have a lot of different personalities. And actually, the personality I trade the most is the fact that it has a variable or an influence based on time passing by, which makes it perfect for long-term investing. In fact, a lot of the participants in my program use options to grow their retirement accounts. Yeah, that's true. They sell options. A lot of people always talk about buying options, buying and then selling them. But today we're going to be talking about selling them in order to generate a long-term investment return. So let's get right into it. We only have about 55 minutes, even less now that I've been talking. I always like to open this. This is just from a few months ago. My mentor posted this on Facebook, and I just love it. I like to start my presentation with this because he's hilarious. But he wrote this. He's like, I just hate to be the guy to break this to you, but most of the self-described experts out there have their heads firmly up there. Beep, right? There are shortcuts to success, but none involve magic. So if somebody's trying to sell you something that seems too good to be true, or that it's magic, it probably is. And he ended it by saying, shame on you if you get involved in some sort of scheme that you know sounds too good to be true. So I always like to start that out because that's the case. I want to throw this chart out. This is a pattern that's all too common. This is kind of a sideways choppy pattern, and most traders can't do anything with this. And sadly, a lot of the symbols we trade, whether they be stocks, ETF, or indexes, spend a good portion of their time doing this. In fact, we spend as traders, short-term traders, we look for the opportunities of when this, the quick timing is that they break this pattern. But the majority of time is symbols like to go sideways, especially symbols that are, offering dividends where the investors, can make money. The long-term investors make money on the dividends, and they're not really even interested in the asset appreciation. They just like having their money in something that's paying better than, say, a mutual fund. But we want to actually ramp that up a bit. And it turns out that options, especially when you sell options, can take advantage of these type of patterns. And if you've been looking at the market recently, these type of patterns are all around us. So here are some facts. Right now, there's a lot of uncertainty with what is happening in the world right this minute, right? We've got conflicts in the Ukraine. We've got, gas prices are out of control here. Food prices are out of control here. You've got, whatever happened during the pandemic is now filtering through our economy. There's been supply chain demand, which has resulted in crazy inflation. The Fed is talking about, it's very uncertain. And you can, if you've ever looked at the VIX volatility index, it's uncertain. It's above average. People are buying a lot of options and they're paying top dollar for them in order to hedge their portfolio. What's happening in the markets, if played right, can set you up for months, if not years to come right now. Remember, even though the mainstream media likes to get their ratings up by saying so many trillions of dollars were destroyed in the markets these past months, the truth is money is not created or destroyed in the markets. It's simply moving from one person's hand to another. And so the key is making sure you're putting yourself on the right side of that transaction. Now, I hinted a lot in the beginning of this slide talking about the VIX volatility index. And when I talked about the VIX volatility index, I mentioned that the VIX volatility index is at an all-time high, meaning people are buying options to protect their long-term portfolios. If you want to be on the right side of the equation, the correct side of the equation, when people are paying top dollar to buy these hedging instruments, shouldn't you be a seller? That's what we're going to talk about today. So first thing I always like to do, and I've got the chat box open, I think I can see what you guys are typing in. What would be ideal for you? Would you like to today, walk away from this multi-speaker event learning how to invest for low risk and high return? In other words, be one of those people who learns how to fish and be 100% self-reliant? Are you one of those people who wants to learn how to invest and have seasoned investors right next to you reviewing your investments before you make them? In other words, learn how to fish, but have expert fishermen there always to help you. And finally, are you here because you just want to follow along with what seasoned investors are doing in their own portfolio? In other words, you want to fish alongside expert fishermen and just basically do what they do. Or maybe you're here for something else. Let me have a quick idea about what that is. Because I'd like to, selling options can be all four of these, really. Maybe D, it depends on how extreme your something else is. Good, good. I'm getting kind of an idea. Okay. If you have any ideas throughout the presentation, you can, of course, keep typing them in. I like to remind long-term investors about compound interest. And the best way to do this, and I know you've seen this a million times, but humor me, is to throw this comparison up. Would you take $50,000 cash right this minute, or would you take a penny that gets doubled every day? Now, remember, the penny that gets doubled every day for a month, this requires you to put in some active. It's kind of the difference between active and passive investing, isn't it? So remember, there's work here in this penny, but which would you take? Especially if you've got the end game like long-term investors have in mind. Obviously, we'll walk through it. In the first week, it looks like, especially with the amount of effort you have to put in to double your penny, it made more sense. You're already a quarter of the way through the month to have taken the 50 grand, right? 50 grand, 64 cents. Oh my goodness. But let's keep going. Now I'm about a third of the way through a 30-day month, and I only have $5.12. I need to multiply this by 1,000. No, 10,000 in order to get this to be that 50. I'm already a third through the work, third of the way through the month. And I'm wondering, was this worth it? Is all this effort I'm putting in it every day to double my penny worth it? Let's speed it up here a little bit. I'm about halfway through the month now. I've only got $163.84 accrued. All right. I'm 3 weeks into the month. The month is already over, or almost over, right? There's 4 weeks basically in a month, or maybe a little bit more, a little bit less, depending on the month. And I've only got $10,485.76. I'm starting to feel a little bit overwhelmed because I've been working so hard, and especially in the beginning, I didn't see much results at all. But look at what happens on day 24, almost towards the end of the month. I finally beat taking that $50,000 up front. And if I continue on, what you'll notice is if I did do this, by the end of the month, I have $21 million, $474,836.48, right? So it does make sense. But the key here is if you're into instant gratification on your long-term portfolio, that's not how investing works. You have to stay consistent. You have to follow a plan. And that's what you're going to hear throughout all of the multi-speaker events. They're going to say you have to be consistent. That's how you grow your portfolio in the long term. And even though in the upfront, the effort may seem almost trivial, or not the effort, but the results compared to the effort that you're putting in, it's the back nine that makes the most. This compound interest, by the way, I'm not sure if Albert Einstein actually said this, but it is attributed to him. Compound interest is the most powerful force in the universe. Take a look at this graph, because this would be like a fantastic long-term portfolio. Speaking of, if you put an investment in and you left it in for a certain, like along the x-axis here, you can see that we've got like 1, 2, 3, 4, 5, 6, 7. Let me change the color so you can see it even better. You leave it in for 7 months, 7 years, and you get this exponential gain in returns. And the reason why I kind of want to solidify this graph in your mind, we're going to revisit it towards the end of my presentation, is because this is what selling options does for you. The longer you stay into the same investment, the exponential growth occurs. So if, we're not going to be doubling our penny every day in real life, what if we focus on doubling, especially like a retirement portfolio, every year? What needs to be our monthly target? So it turns out this is simple interest, not actually compound interest. If you earn 6% on your money every month, so if we focus on growing that portfolio by 6% every month, then our investment will more than double every year. Now, even during this crazy tumultuous time, my program participants that we're watching closely are actually growing their portfolios by double digits every month. They're actually doubling their portfolio every 5 to 6 months. But we aim for the moon and go for the stars. So if we focus on making a minimum of 6% return on our money every month, then we are going to be doubling our portfolio every year. So what does that mean? That means if I have $1,000 portfolio, and a lot of people ask me, how small of a portfolio must we have, or how big, what are the size, what's my limitation? Well, of course, we're talking about investing, right? Investing by definition means growing your money. So if you have no money to begin with, you might be in the wrong place to learn how to invest, right? You need to have seed investment, but I've seen people start with as low as $800 when they're selling options. Now, the ideal spot is to have like a annual, the amount that you can put into a Roth IRA these days, which is around what, $5,000, $6,000, something like that. That's like a nice spot to start. But even if you just have $1,000, like we're showing on your screen, that's great, because at the end of 12 months, you'll have $2,012 if you focus on just 6% per month. $4,048 in 2 years. In 5 years, if you just focus on that $1,000 and the 6% per month, you'll have close to $33,000. And in 10 years, you'll be a bona fide millionaire, right? This is the retirement plan that I've been following, except I've been doing it on an accelerated pace. I started with a $5,000 investment back in 2003 to prove people that this is possible. And now I'm dealing with an 8-figure portfolio, right? I'm set for the rest of my life, and so is my family for generations to come. But even better, say you grow your portfolio to $100,000. Growing your portfolio to $100,000 and then just focusing on this 6% target every month, that's going to generate potentially about $101,219.65 per year. That's more than a salaried person makes in a year doing a white collar job where you're, working 60 hours per week. But in this case, you're just managing your portfolio. Most of my program participants, once they've got the strategies down pat, spend less than about 10 to 15 minutes per evening just looking over their portfolios, seeing if anything needs to be done. So what is it that we're actually talking about? So in nerd speak, we're selling theta decay optimized option premium. That's geek speak right there. In other words, we're profiting on time passing by. So options, like I mentioned in the beginning of my presentation, do have a component that is influenced by time passing by. So if you structure these strategies correctly, you just place the trade, and at the end of every month, or it's actually the third Friday of the month, we have our payday. So let me just review a little bit. I want to make sure you are following along. What minimum returns must we focus on monthly if we want to double our portfolio more annually? Is it 0.5%, 1.5%, 5%, 6%, or is it 10%? What are the numbers we're looking for? A lot of people are typing into the chat box 6%, and that's exactly right. So let's keep going. A lot of people have this preconceived notion that options are risky, that you don't use them in long-term investing, whereas the big money traders know that they're the only things you should be using in long-term, because not only do options profit when the market goes up, options can profit when the market goes down, and especially options profit if the market goes sideways. Even better, options profit when time passes by. Options could even profit when there's fear and confidence in the market. These things, these investment vehicles, if you really get into the nuts and bolts of them, are really the most flexible kind of investment vehicle. You can basically trade an option strategy against any pattern you identify and profit off of it, right? When you talk about trading stocks, indexes, ETFs, commodities, crypto, the price of the instrument either has to go up or down for you to profit. Up is if you buy it and sell it at a higher price, and down is if you short it and then buy to close it at a lower price. Either way, that's two strategies. Last time the mathematicians looked at the different option combinations and permutations, they came up with 26 different ways to profit on a pattern compared to 2. So the flexibility you get in options is what's drawn me all these years, right? There's been so many ebbs and troughs of what's been interesting over the years, right? At one point, all of a sudden, everybody was interested in Forex. Then crypto came along. Everybody was, it's whatever is the shiny object. I've always focused on options, and it turns out I'm still around, and those other companies, have gone by the wayside. So what is this thing called an option for those of you that don't know? Well, again, geek speak, it's a financial instrument that's called a derivative. It's derived from whatever the underlying symbol. It's typically bought and sold in order to hedge risk against stocks, indexes, ETFs, but that's not how we're using them. What we're doing is we're selling their premium to generate monthly income into our portfolios to grow our long-term portfolios, right? All right. Before I go farther with these slides, this is a little slide to introduce you to me, but just type into the chat box, do you know who I am? Because if you are, we'll just pass these slides. I've been a participant in these speaker events for a while here, and so I just want to know if you guys know who I am. Okay, we got a mixed bag here, so I won't spend too much time on these slides. Listen, you can find me all over the web. Here are some shortcuts to go to my YouTube channel. You can listen to my podcasts on whatever your favorite podcast thing is: Spotify, Apple, iTunes, Google Play. I've got Facebook pages, Twitter pages. I've got articles I've written, White Pot. What's not on here is now I'm big posting on both Instagram, some of my charts, as well as TikTok. Thanks to my marketing team for that. I wouldn't even know what TikTok was, but that's because I'm an old fart. So feel free to check me out online. And of course, if you do, give my channels some love by hitting the thumbs up, subscribe, or and the notifications bell. It's funny, I see somebody in chat saying, are you on the NFL? It's funny, I used to be the top of Google search, but I can't seem to compete against a young gentleman who has really caught his way into the NFL. So I used to be the guy on top. Me and this other guy in Kansas who owned AJ Brown's Construction. But yes, there is a guy on NFL, and sadly, I'm not a football player. Instead, I founded this company called Trading Trainer. They call me the world's most disciplined option trader. I think they call me behind my back the laziest options trader. I think of myself as the most efficient options trader, and that's just because I like to take the fewest number of steps to grow my long-term portfolio. One thing you'll know about me is I'm not a day trader. In fact, I'm an end-of-day trader, and I trade maybe 3 or 4 times per month. I'm not in there actively every day. I have been doing this since 1997, and I started Trading Trainer back in 2002. I've got eBooks and home study courses out there. I've got a mechanical. When I first started coming out of college, I was a mechanical engineer. I've got electrical and mechanical engineering backgrounds. I've also got a strong background in commercial business and investing. And since my mid-30s, I started taking classes to be able to teach, right? You know, there's a lot of people out there that can do things, but I have found that some of those people who can do things that you want to do don't know how to teach, right? They don't know how to coach. And so I have, for the last 15 plus years, been enriching myself so that I can be a better person. So I like these things called accelerated learning methods, where I can teach people how to trade. And my big, just to kind of give you a history, back in the mid 90s, when I started all this, I started going to seminars just like probably a lot of you. Of course, my seminars were in hotels. Maybe some of you remember where you'd go in on a Saturday, and the next thing you know, you'd pay a chunk to come back on Sunday, and then the next thing you know, you're flying somewhere to spend 3 or 4 days. And I spent $27,000 on seminars my first year, and then I spent $85,000 on stupid investments. I lost it. I figured this was my second college degree, right? Here's something you might want to take notes on. This is what I learned. Number one, don't chase shiny objects, right? Everybody's going to try to present something to you, but settle on one type of investing and learn it well. And when you choose that type, don't just choose the one that seems most exciting to you. Choose the one that meets your lifestyle, right? A lot of people say, I want to be a day trader. And then as soon as they're trained as a day trader, they realize that day traders usually have like a much lower lifespan, right? Because it's so stressful and it's not actually that fun. So figure out exactly what your lifestyle will accommodate, or your dream lifestyle, and learn that, right? Number two, this is again something I learned through trial and error. So I hope you just take these notes and follow them so that you don't have to take the scenic route like I did. Hire a mentor who is currently doing what you want to do, and as I mentioned earlier, knows how to teach it. I call this learning from guided discovery. It's so much easier and just as effective as learning through trial and error. This is a big one. This is one I really followed. Join an investment group, right? In other words, a place where you can look over each other's shoulders, leverage with pride, and also be around people who aren't going to jinx you. Like when you get into some sort of investing that's not just buying a mutual fund, people will start, putting negative thoughts in your mind, like, oh, that's really risky. And then you'll start second guessing yourself. Whereas if you're an investment group that's doing all the same thing, well, then you'll have more support. But also leveraging with pride. Back in the early days of school, if you remember back to your elementary, they called that cheating, and they said it wasn't allowed. But in the real world, like in engineering and all of that stuff, we all reverse engineer and we all leverage with pride. We look over each other's shoulders, and that's how you learn the quickest, right? Finally, surround yourself with like-minded investors. Naysayers will always try to convince you that you're wrong. Do these 4 things and you will find success in investing. Because this is exactly what I did. All right. Last thing about me is my foundation. I always have to give it a plug. I take historically underserved inner city kids off the street. I teach them how to invest. I started in 2003 with 9 kids. We were stuck using a public library, which only let us use the internet for 30 minutes every day on a DSL line. If you remember back to 2003, we were just moving from modems that called over the telephone with all those sounds like beep, boop, 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 to DSL lines. And the library had it, but limited us to 30 minutes. And after 6 months, I gave each one of these kids $2,000. And I thought I'd never see that money again, but they all paid me back. In fact, they're all grown up now. And a lot of these kids are, like, one of them's teaching at Denver University, teaching finance. I love it. These kids are like my own kids. The scoop is we've been doing this foundation every year since last year. We actually graduated over 250 inner city Chicago kids. We had to take a break because of the pandemic, but now we're back at it. So I always like to plug my foundation. Okay, back to the content. How do we sell premium? Get your note pencils out. We focus on 4 simple transactions: writing covered calls, writing covered puts. We're using a lot of these right now. You might want to circle that. Flipping the covered call upside down. We write covered calls against leaps. Geek speak, it's called bull call diagonal debit spreads. And we're also writing covered puts against leaps. Again, this 4th strategy is one of the most popular strategies we're using right now. This is supercharged covered put writing, or in geek speak, we're using a variant of bear put diagonal debit spreads. What's nice is 3 of these are cash trades that can easily be done in any sort of retirement account. This one right here, the covered puts, does require a margin account, but the variation of it, writing covered puts against leaps, the bear put diagonal debit spread at the bottom, this guy over here, can easily be done in a retirement account. It's a cash trade, which means there's no margin requirement, and it has the same effect as this guy right here. So just keep that in mind. These are fairly straightforward. I'm not going to talk about all 4 of them today, but I am going to talk about, just to give you an idea how it works, we'll talk about some call writing. An options price is equal to 2 components, right? When you look up the option price on the big board, you've got an in-the-money value. Geek speak, it's called intrinsic value. Premium value is extrinsic value, right? And if you add those 2 together, you get whatever the price of the option is. So with that thought in mind, we're optimizing on the premium. The last time I checked Ford, which was over the weekend, right after July options expired, Ford was trading at $11.88. So if we bought shares of Ford and then immediately sold this Ford August $12 call, it's going to expire on the 3rd Friday of August, we'd get a 65-cent per share cash back, right? We'd get basically a discount on our Ford stock. You can look at it that way. You can also look at it as an instant dividend that we'll receive. And this is going to act like an expiring coupon, right? It means that, for instance, as the 3rd Friday of August rolls around, this will wind up being worth nothing. We sold it and we won't have to pay anything to get it back. It'll just disintegrate in front of us, right? So let's run through the scenarios. What happens if Ford closes above $12 on August 19th? All right. We paid $11.88 for the Ford share. We're going to get $12 back for getting exercised out of that call option. That's going to give us 12 cents per share profit. But don't forget, we got our 65 cents up front, that instant dividend, which will wind up giving us a total profit for the month of 76 cents per share, or a 6.8% ROI, right? 1 day of trading, 2 transactions. But what happens if Ford is flat? Now, this is actually the ideal case. $11.88 to buy Ford, 65 cents back for selling the Ford August 19th $12 call. That gives us a 65-cent profit to date. We keep the Ford stock. We made 5.7% ROI so far. And here's the key. We do it again and again and again. Each time our break-even price gets lower, and that means our gains exponentially increase. This is actually what we like to happen, and this happens on sideways moving stocks. But a lot of people always ask then, what happens if Ford drops by August 19th? Well, stay tuned, because I am going to show you an active way to reduce our risk on return that we all do. But in the meantime, all of these strategies have what we call a profit buffer. In other words, that 65-cent rebate on the break-even price drops our Ford stock price down such that we get a 65-cent per option sold profit buffer. In other words, the stock would need to drop by 65 cents for us to even get out of the black zone into the red. Now, again, I'm going to show you an even more active way to reduce the risk further, but this is pretty cool that this strategy has it built in. Now, that's just theoretical. Let's look at a trade we did recently. This is Huntington Bank. I have it in my log here. This is one we issued out to our program participants. June 22nd, we said buy 800 shares of stock. That comes out to just shy of $10,000 investment. You'll notice then we got our instant dividend. Now, we did this on 2 different days. We bought the stock on June 22. We sold back the $12 call on June 28. We got a 68-cent dividend. Notice this is like a week apart. So again, we're not in there trading every day. And then on July 15th, this all happened automatically because the option expired worthless. We got to keep the 68 cents, but we also got called out because the stock was a little higher than $12. And so we wound up walking away very easily with 4.5% ROI on that investment. Not bad, right? Of course, it's not that 6%. So let's see if we can take it to the next level. Before I take it to the next level, let's do a comprehension. What does investing by selling premium create? What did you hear today so far? An instant dividend, a discount on a security, a profit buffer, or an expiring coupon. What do you think? If you said all of them, you're absolutely right. All right. Now I'm going to ask you some questions ahead of the lesson. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? So I'm asking you to kind of guess, and I'm going to tell you the answer, and I'm going to explain it. Should we sell out in time options? Should we replace the security with options trading at parity? Should we give up and buy mutual funds, or is what I'm talking about not even possible? So we want to lower our investment and increase our returns. So selling out in time options actually doesn't work very well. I'll tell you why. The longer you've sold an option, the more you're under a commitment, an obligation. And so we actually don't like to be under that obligation any longer than we have to. And there's diminishing returns the longer you go out. The sweet spot is about 3 to 5 weeks, no less than about 8 trading days. But any more than that, and you're not going to get the payback you want. So the real answer is replacing that security with something else that acts like it, but is cheaper, right? So I said this option trading at parity. What the heck does that mean? Well, we talked about option premium and option in the money value. The option premium is the most when we use options that are called, quote, at the money. But when we go deep in the money, the option loses its premium and it becomes what we call in the money value or intrinsic value. Now, that's a lot of nerd speak to just say a deep in the money option behaves just like the stock, the index, or the ETF. It moves dollar for dollar. So for instance, a deep in the money option, if the stock is at $100 and the deep in the money option's at $10, if the stock moves up to 101, then the deep in the money option moves to 11. So it moves dollar for dollar, only it's cheaper to start out with. So you might say, okay, but these things have expiration dates. How far out should we go in the expiration date? Well, we want to make sure that these options that we're substituting for the stocks, we want to make sure that these things don't expire on us when we're collecting money off of them, right? That would be like buying a piece of rental property, having renters in there, collecting those rents, having it cash flow positive every month, and then all of a sudden having your building disintegrate when everything was going well. So we go out as far as we can to sell as many cycles. And so this is statistically, most of my program participants, when they place a trade, on average, it lasts for about 5 months. Some last for 6, 7, 8 months. Some last for just 2, 3, 4 months, but the average is 5. We want to get most of the time in there. And so it turns out if you go about 8 months out in time, you're covered. So keep that in mind. Write that in your notes. We typically use option leaps, by the way. Leaps are the January expiring options. And these things just happen to have more liquidity, more of a market. But it's not necessary to use leaps. It's more necessary that we go far enough out in time and deep enough in the money. Write that down in your notes. Hope you're getting a lot out of this training. So let's go back to our Ford example. So I could pay $11.88 for my Ford stock, or I could substitute that with a Ford June 2023 $5 call. That's more than 8 months out from now. And that thing's only going for $6.93. And this shows how much that back month option has in intrinsic value versus premium value. It's almost all intrinsic value, meaning it's moving dollar for dollar with the Ford stock. So, okay, we buy that instead. We buy that guy, and then we sell our near-term at-the-money option for the premium. We get our instant dividend. We get our discount on the back month option. We get the expiring coupon. By the way, you might be asking, why is the instant dividend $65? Options, if you didn't know this, are sold in lots of 100. So whenever we're doing anything with options, we're always talking about option contracts, and option contracts consist of 100 shares of options. So let's run through this example. If Ford closes above $12, we get $6.93 is what we paid for the back month option. Because it got exercised, we get the difference between the $5 and the option that we sold, which was $12. And so that's a $7 difference. That's why it's called a diagonal debit spread. So we get $7. That gives us an 8-cent profit. Plus we got the 65 cents for selling the option in the first place. That gives us 72 cents. Which turns out to be an ROI of 11.5%. Now we're talking. Somebody asked, why August? Because that's the near-term option, right? And I think I have here, it says June 2023. This is wrong. No, that's right. Yeah, because it is now July 19th. The third Friday of July was July 15th. Now, you could use weekly options. I stick with the monthly options for my own portfolio because there's a lot more liquidity and my portfolio is really big. And so I have to be where there's lots of liquidity. So I focus on the monthlies, but there are weekly options if you want to focus on doing this every week. So the July option expired last Friday. Last Friday was the third Friday of July. So the next option is August 19th. Great question. What about if Ford goes flat? Now, again, this is the ideal case. That means we spent $6.93. We get 65 cents back. We keep the 65 cents, 10.3% ROI, and we get to do it again and again, reducing the break-even price of our back month option. And like I said, most of these positions last on average 5 months for us. And if Ford drops, that's okay, because it actually builds us in a profit buffer. For the Ford back month option would have to drop all the way to 628 for this to even go into the red. And in just a few seconds, I'm going to show you how to reduce the risk on return to nil as well. So a reminder. Oh, I don't want to do that. What I want to do is I want to show you a real trade. We did Pulte Homes. So June 23rd, we bought the Pulte home, January 2023, $23 call. So that was our back month option. So instead, I think Pulte Homes was trading up around $39, $40, $42, something like that. We were only buying the back month option for $17.45 a share. 6 contracts, 600 shares, just a little bit north of $10,000. And then we sold on July 6th. So again, one transaction on June 23rd. About 2 weeks later, we told our program participants to go ahead and sell the July 6th. So they went ahead and did that, $3.20 cash back. And then on July 15th, when everything expired, we actually got exercised at the $17 price. And well, we got exercised at the $40 price, which means we had to exercise at the 23. By the way, all of that happens automatically. The broker does it for us. We wind up with the difference, $17. It all came out to a return on investment for us on this trade of just 15.6%. So again, one transaction on June 23rd, one transaction on July 6th, walk away with 15.6% ROI. Starting to get it? All right, let's put in the last piece of the puzzle. This is just a reminder that if you focus on 6%, your investment doubles every year. How can we drastically reduce our risk on return? What do you guys think? Should we just go half as much option premium? Should we sell out in time options? Maybe we should be collaring the investment by marrying a protective option, or is what I'm talking about not even possible? What do you think? If you're thinking collaring the investment, you're absolutely right. So let's bring ourselves back to this graph here, because this graph is actually one of my favorite trades that I've done. It's on ticker PAAS. So as you can see, this didn't last 1 month. This actually lasts many, many months. It actually started in August 2020 and went all the way down to October of 2021. It's a great example because here's what I wound up doing. I bought my stock, right? And then days later, so August 26th, September 1st, not only did I sell premium, but I married that protective option. So now if I go below the strike price of that protective option, I'm protected. In other words, that protective option will gain at the same rate as the stock is losing, and it basically stops all risk at that strike price. So take a look at what happened here. I sold the premium for $1.76 and I bought the protective option for $4.75. On the third Friday of the month, the premium expired worthless. I got to keep that $1.76 per share. And then I got to, because I didn't need the protective option, I only need the protective option when I have premium sold. I sold it back at a profit. And a lot of people don't understand that. So a lot of people will go ahead and put a protective option in place, but they'll buy one at a loss. The way we do it is we always buy our protective options, so it gives us an additional source of income. That's kind of the trading trainer secret sauce. So not only did I make $1.76 by selling premium, but I made an additional $1.15 by rolling out the protective option. And then guess what? I'm left with the stock, and I did it again. The next month I sold $1.47 premium, bought the protective option for $3 and a penny. Premium expired worthless, sold the protective, rolled it out for $3.62. So I made $1.47 on the premium, and I also made 61 cents on selling out the option. So I just keep doing that every month. Now I've got two sources of income instead of one, plus I'm protecting myself whenever I have premium sold. It's kind of brilliant. And notice, if you look at these dates, I'm not day trading. In fact, I'm doing like 2 transactions a month, and that's it. So this is like really something, and it's all end of day. So it's not something that interferes. This is perfect for long-term investment portfolio growth. The other thing I want you to notice is look over here in this column here called cost basis per share. And notice right after the first month, my cost basis drops to $31.86. But notice my protective option, it's at $34. So think about that a second. This is actually a graph of that trade. So here's what I want to point out here. Note, well, actually, I think it's built into the slide. Let's go through it here. So first of all, that's my break-even price. So notice, yes, right in the first month, there was a chance for me, if things went against me, for me to lose just the tiniest amount of my investment, or if I got exercised. So getting exercised is the orange line, getting bailed out or stopped out is the gray line. Notice the amount of possible return on risk even from the first month. But then after that first month, notice what we've got here. Whether I get bailed out or whether I get exercised, I'm guaranteed profit. This is the average time our premium selling investments last. And when this is exercised, we would be guaranteed 65%, but even better is if the trade goes against us when we get bailed out, we'd still be guaranteed 50% ROI. So it gets to a point here after the initial month of the trading, again, because of compound interest, that we don't really care if the underlying stock goes for us or against us, because either way, whether you're making 50% ROI or 65% ROI, I mean, now you're splitting hairs. They're both great returns for your long-term investment. Do you get that? So this is where the trade became risk-free, just shortly after placing the trade. So what do we have when our break-even price is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Too much complexity? Or a pipe dream? Hopefully you guys see that now these trades, somebody wrote in nirvana. I'm not sure it's nirvana, but it's really profiting on the fact that options decay with time. Their price decays with time. So we're not caring whether the stock goes up, down, or sideways. We'd like it to go sideways because that just lets our trade accrue interest over time longer. But if it goes up or down, especially once we get past that into that Goldilocks zone, it doesn't matter because we're guaranteed a profit either way, right? It becomes a risk-free investment. So here are the 3 steps. This is where we want to summarize everything and finish my presentation. We're going to buy or short an underlying security, or even better, we'll buy a substitute option trading at parity. Then step 2, we're going to sell a near term, and for right this minute, that would be an August trade. unless you're doing weeklies. Sell a near-term at-the-money option for its premium value, get an instant dividend, and build up that profit buffer. And also, to reduce that risk on return even further, collar with a married option that is 3 to 6 months out in expiration to protect your investment. So you notice that I was not doing the transactions on the same day. So what I like to do is just use simple timing signals like a MACD or something like that. And if I'm at the bottom of a sideways channel, that's when I would buy an underlying symbol or the call option trading at parity and put a stop loss in place. And then when it tops, sell a near-term call option, buy my protective option. That near-term call option expires on the 3rd Friday of the month. And of course, I can then sell back my protective option at a profit. So that's this timing of the position. By the way, we didn't discuss the covered puts, and this is what we're doing right now, or the variant where we substitute. But if you decide that you're going to start at the top, then we would short an underlying symbol or buy some put options trading at parity, put our bailout trade in place, a stop loss. When it gets to the opposite reversal, sell a near-term put option, buy your protective option. The near-term put option expires worthless. We sell back our protective option, rinse and repeat, rinse and repeat. Again, these are daily bars, and you'll see that we're only doing transactions, about 2 transactions per month. So this is perfect for long-term investing. So here's the question I have for you. How would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, and of course, have support whenever you need it? In other words, how would you like to save some time, create some clarity, and get some results? Well, then, would it be okay if I take just a couple of moments to tell you a little bit about my materials, my training, and my tools to see if they might be a fit for you? Thanks. Some of you are saying yes in the chat. I love that. This is for someone who doesn't want to pay for a bunch of different data subscription, wants everything they need in one place, doesn't want to miss any of the opportunities, wants to spend more time doing other things. That's my big one. I'm all about family right now and hobbies. Doesn't want to do this alone and wants step-by-step instructions. In other words, in summary, someone who wants to get consistent and reliable results. I'm going to skip that testimonial. It's pretty cool, though. This is a woman. I'll just summarize it. A woman who was a teacher. Teachers are one of the most underappreciated professions, I believe, in our country here at the States, if you're in the States. And she got cancer. And she got to the point with her chemo and her radiation treatments that she couldn't stay standing in class. And so they actually forced her to retire, and she wasn't able to collect her full retirement. And so she was ready. She subscribed to passing away. And the scoop is she didn't. And that kind of sucked because, again, in our country, that doesn't, you don't get kudos for that. In other words, you get lots of bills. And so she came to me and we started trading together. And, now all she does is read her daily table, finds the stock she's interested in, follow the strategy. She recently made 14% by just spending 15 minutes reading about the company, following the chart, and then waiting for expiration. It's kind of cool when I get to be part of not only my foundation kids' success, but also people like this. So just quick, there's video tutorials. I have a monthly live class where I do a lecture. In fact, the live class is this evening. We always do it on the Tuesday that follows options expiration. We have a bunch of screeners, bunch of planning tools that we give you. This is the favorite part that I have. We do every Thursday a live workshop. We have like 400 people come, and we have replays for people who can't make it, where we actually plan out a trade. And everybody takes that planning, adjusts it for their portfolio size and risk tolerance, and then goes to the races. It's awesome. You can't miss those live workshops. Also, if you do your own planning, we have a way for you to actually send me your planning, and I will review it personally to make sure you're not going to mess up, right? It's called Trade Review. So how much is that all worth to you? Let me also tell you about our double your money back guarantee. So I'm going to ask that you do this for 6 months. Now, that's not because it's going to take 6 months for you to learn. In fact, most people learn it in about 3 or 4 weeks of just following along with our webinars. But it's because I want to be there to review your trades for the first 6 months, especially if you're new to this, or even if you're not new to it, maybe you haven't done it my way with doing the protective options where they become a source of income as well. So I like to be there to review your trades. Do this for 6 months. If you don't make a profit at the end of 6 months, I'll not only give you the money you pay for this program, but I'll double it. And I've been running this guarantee since I started this program in 2007. Guess how many times I've had to actually honor it. And that tells you how successful we are. Also, I'm going to give you a strategy session with one of our coaches, which will help you point out how to get from point A to point B. So if you add those two things in, the double your money back guarantee and the bonus strategy session, now what's it worth to you? Well, the price is $597, so about $100 per month. That's a flat fee. It's for all 6 months. You're never going to get charged again. And because this multi-speaker event is just so freaking awesome, I'm going to give you a $100 discount, reduce the price to $497. So what you have to do, and David will put this into the chat for me, I know, because he's always Johnny on the spot. You have to go to optionsinvesting.org/synergy. Optioninvesting.org/synergy. It's going to look like a page like this. And you can see the $597 price. Put down, and this has to be all caps, 100 DISC, 100 disc. That's short for discount. And you put that right here into the promo code area, 100 capital DISC, apply, and it'll reduce the price of it to $497. Make sure you use that promo code. I don't want anybody on this call today paying more than the $497. So do that. Go to optioninvesting.org. If you've got a mobile phone, you can just scan the QR code. And if you're having troubles, write down this phone number. It's our office number, 970-266-8146. Tell them you are on this webinar, and they will make sure you get the $100 discount. Folks, do this for your long-term investing portfolio. I'm telling you, selling option premium is a skill that will literally put together a retirement package for you, no matter what the markets are doing. Thank you for your time today. Thank you, David. Thank you, everybody at Synergy.